Hello, investors. This is the Super Investor segment of AI Insight US Stocks, and I am your Chief AI Analyst. This program is for learning and reference only and does not constitute any investment advice. Investing involves risks, so proceed with caution. Today, we're going to analyze a really interesting CNBC article that gets to the heart of a huge question. A simple reason why the market's biggest investors say they aren't worried about AI bubble, tech stocks selling. And here's the hook that gets everyone talking. Despite all the chatter about a bubble, tech stocks are still hanging out near their all-time highs. So what is going on here? You can almost feel the anxiety in the market, can't you? It's this sense of déjà vu, with a lot of people nervously looking back at the last major tech crash, wondering if we're about to see a repeat. And that brings us right to the million-dollar question, or maybe trillion-dollar question. Is history repeating itself? I mean, with the market's recent ups and downs and so much money piled into just a handful of companies, the Magnificent Seven, it's super easy to see why people are drawing a straight line to the year 2000. So, to get some real clarity, let's look at this whole situation from the perspective of the people managing these massive funds. Their viewpoint isn't shaped by the daily noise, but by some seriously deep, long-term thinking. At CNBC's Delivering Alpha conference, two heavyweights really laid out their case: Philippe Lefant from COTU Management and Bill Ford from General Atlantic. Just to give you a sense of scale, their firms together manage nearly $200 billion. So yeah, when they speak, people tend to listen. And this quote from Bill Ford is pretty much the core of their whole argument. He says the people driving change in AI are the large public companies and the incumbents. They have the advantage. Right there, he's saying this isn't like past bubbles that were all about risky startups. This time, the big established players are in the driver's seat. So the whole idea is that this time, it's genuinely different. And it's not just a hunch either. It's based on some really fundamental differences between now and then. Let's break that down. When you put the two eras side by side, the difference is just wow. The dot-com bubble, that was all about speculative IPOs from companies with, let's be honest, pretty shaky business models and mountains of debt. But today's AI boom, it's being paid for with the enormous cash flows from companies that are already profitable. It's a completely different ballgame. And this brings us to a really important idea that Philippe Lefant talks about, the hyperscaler advantage. This is the secret sauce. Giants like Google, Microsoft, and Amazon don't need to go begging for money. They can fund this entire revolution out of their own pockets. And the sheer scale of the money we're talking about is staggering. Wall Street thinks these hyperscalers could pump over $500 billion into AI next year alone. Let that sink in. That's not just a little froth. That's a tidal wave of strategic capital. Lefant's quote here really hits the nail on the head. He says these are investments made by companies with real boards and return on capital requirements. In other words, these aren't just wild bets. Every dollar has to be justified. The whole system is built on a much, much healthier foundation. All right, so the money funding this boom is solid. But what about the valuations themselves? This is the other crucial piece of the puzzle. It's not just hype this time around. It's about the bottom line. And this quote from Bill Ford says it all. The dot-com era was obsessed with chasing eyeballs, just getting users, without any real plan for profit. Today, he says the earnings are there. The incredible rise in these stock prices is actually being backed up by an incredible rise in real, hard profits. And if you need a perfect real-world example of just how different things are, look no further than the ultimate value investor himself, Warren Buffett, and his recent moves with Alphabet. To really get this, we have to rewind to 2019. Back then, Buffett pretty much admitted that they screwed up by not investing in Google way earlier. He felt like they had completely missed the boat. Now check out this timeline. In 2019, he's regretting not buying at around $59 a share. But then fast forward to 2025, and his firm, Berkshire Hathaway, actually buys a stake after the stock has blown past $170. For a legendary value investor to buy after a run-up like that, well, that speaks volumes about just how strong he thinks the underlying business is. Okay, so the present is built on solid ground. But what about the future? Where is all of this heading? Well, this is where the long-term vision gets really, really exciting. Philippe Lefant uses this great, simple analogy to explain a really powerful economic idea. He says to think of AI compute, the raw processing power for AI, as being like gasoline for an engine. He breaks it down using a classic formula.
Price times quantity equals the total market. Here's the twist. The price, or P for a single unit of AI compute, is going to drop like a rock. But the quantity, or Q, the number of things we can actually do with that cheap intelligence, is going to explode to a number that's almost infinite. So even as the price per unit goes down, the sheer volume of use cases drives the total market up and up and up for a decade or more.
And what does that infinite quantity look like in the real world? We're talking about everything from intelligent software and self-driving cars to humanoid robots, hyper-efficient customer care, and so much more. It's a complete transformation of pretty much every industry you can think of. So, it all leaves us with this one big mind-bending question to think about. If the fundamental price of intelligence itself gets closer and closer to zero, what becomes possible? Conclusion for this episode: the AI boom is viewed by top investors not as a speculative bubble, but as a fundamental shift led by profitable incumbents with strong earnings and disciplined investment strategies. Type 1 in the comments to show your support. We'll analyze the next dynamic then.